Hello. In this video, we're going to be talking about what happens when the financial statements are prepared between the interest payment dates for bonds. So when an accounting period ends between the interest dates, then you have to record the interest that has accrued since the last interest date. So what we're talking about is we have had many examples where a company issues bonds and the payments are, on June 30th and December 31st, and the issuer has a 12/31 calendar year end. What happens if the issuer does not have a calendar year end, or what happens when the bondholder does not have a calendar year end? How do you prepare the financial statements then? So that's what this video is all about. We're going to go back to the same example we've been using in prior videos, which is on January 1, 2027, Masterware Industries issued $700,000 12% bonds dated January 1. Interest of $42,000 is payable semi-annually on June 30th and December 31. Bonds mature in 3 years. The market rate is 14%, and United Intergroup is the bond holder or the investor and plans to hold it till maturity. The difference between this example and the prior examples in other videos is that this says the fiscal years of Masterware and United is October 31. Okay, not December 31, but everything else remains the same, which means the interest was last recorded on June 30th. So here we have a 6/30, we have a payment made, and then we're going to have our next payment is going to be on 12/31, but here on 10/31 is a year end. So what happens, right? The companies have to accrue interest at 10/31 for the 4 months between June 30th and 10/31. So from June 30th to July, August, September, October. So that's 4 months out of the 6-month period that will be paid. So let's go to the adjusting entry that will be needed on October 31st, assuming that's the new year end. Just want to quickly go, we're going to assume we're using the effective interest rate method. And if you don't know what that is, please go to the video that discusses that. But this is our second payment date on 12/31. Our interest payment is $42,000, which is 6% times the face amount. And then our effective interest this is the expense. Here's the expense that we need to record for the 6-month period ending 12/31. And this is going to be our decrease in the discount on bonds payable, or this is what we usually credit every 6 months, that number for 12/31/27. So I'm going to go first. If we were a December 31st year end, this would be our entry, okay? We would have recorded interest expense for $46,991. We would have credited our discount bonds payable for the $49.91, and we would have paid out cash for the interest payment of $42,000. This is, by the way, for Masterware, which is the issuer of the bonds. However, for this example, this is not what we're doing. We're not a December 31st year end. Instead, we're an October 31 year end, which means we need to accrue the interest from the June 30th to October 31, which equals the 4 months out of the 6-month period that this is calculated for. So I'm going to erase this just for the time being. Again, we don't need this 12. This is not what we're doing. I just want to show you what it would have been had we been a 12/31 year end. The interest expense on October 31, we need to accrue 4 out of the 6 months. So for the 6-month period between July 1 to December 31, right, this payment, we would have accrued $46,000 of interest expense. Now on October 31, it's only 4 out of 6 months, so we're going to take the 46,000 times 4/6, and we're going to debit interest expense for the 31,327. This at 12/31, we would have recorded a credit to discount bonds payable for the full $44,991. but instead we're just going to do 4/6 of that. So that would give me a credit to discount bonds payable for $3,327. And here's the big difference that you should be aware. We are not actually going to pay out this interest payment. The bond debenture says that the interest payments are paid on June 30th and December 31. So the interest payment will be paid out on December 31. So on October 31, when we have to actually close our books, we owe that interest payment 4/6 of that, right? 4 out of the 6 months. So we're going to credit interest payable for $20,000, which is the 42,000 times 4/6. Okay, that's what we're going to do on on October 31 if we have October 31 year end. Now we're going to fast forward to December 31, the actual interest payment date, right? This is when we actually pay out the 42,000. So I'm going to include here's the entry, right? Now we're still masterer, we're still the issuer with the October 31 year end. This is what our entry would be actually on December 31. But this is just from the prior slide. This is the entry that we actually did record on October 31. Now, 2 months later, we have our December 31st, where we actually are going to make this payment. Well, first, we're going to, here on October, right, in October, we accrued 4 out of the 6 months of interest expense. So in December now, 2 more months have passed. So for November and December, we're going to debit interest expense for the rest of the period. So 2 out of the 6 months interest expense. Our interest expense in total for the 6 months is $46,991. So you take that times 2/6, and that's how you get the $15,664. Our interest payable, the same thing with discount. I'm going to skip over. So that's this entry right here. I'm going to go over to this third line. Here, on October 31, right here, we credit our discount bonds payable for 4/6 of the 4 out of the 6 months for the $49.91. Now we're going to credit the discount bonds payable for the remaining 2 months. So we're going to take the $49.91 multiplied by the 2/6, and that's how we get the $1,664. And also in our entry, now we're actually paying out the $42,000 to our bondholder. So we're going to credit cash for the full $42,000. Okay, now back to our October 31 entry, we have this interest payable that we accrued on the 31st, right? Because we said we know that we are going to owe $28,000 of interest come December 31st. Now we're paying that $28,000 plus the additional 2 months of the interest payment. So now we no longer owe this payable because we're already paying it. So we're going to debit, right? So this right here, we credit it on October 31st, and we're going to debit it on December 31st. So here's just a clean copy of everything without my markups that you can just see everything clearly if you want to pause the video and take a look at compare the October 31 journal entry to the December 31 journal entry. Okay, now we're going to go through the entries for United, which is the investor, the bondholder, assuming they have an October 31 year end. Okay, so still the same thing. We have our using the effective interest method. They're going to get, United's going to receive a $42,000 interest payment on December 31, right? And they should accrue revenue for $46,000 and debit their discount on investment account for the $4,991 for the full 6 months. So this would be this is their entry if their year end, right? If their year end were December 31st, this would be the entry. They would have received $42,000 for the interest payment. They would have debited discount on investment in bonds, and they would have credited interest revenue for the $46,991. However, in this example, they do not have a December 31 year end. They have an October 31 year end. So again, just like Masterware, they need to accrue their interest that they've earned and that they're going to get from July 1 to October 31st, which is 4 months out of the 6 month period. So instead of receiving, they haven't received cash for 42, but they're owed in the interest, right? So they're going to debit interest receivable for the 42,000 times 4/6, which is 28,000. They're going to debit their discount on investment bonds, right? Just like they would otherwise, but only for 4/6, right? So this is the 49.91 times 4/6. And they're going to accrue they're going to recognize the interest revenue, the 46,991 times 4/6. They're going to credit interest revenue for $31,327. Now we're going to look at what their entry is going to be when they do finally get to 12/31, which is not their year end, but that's when they're going to go, that's when United will receive their cash payment for interest of $42,000. So on this top here, this is just the previous entry we did on October 31, just so you have it for reference. And then on December 31st, when they finally do receive that money, they're going to debit cash for $42,000, and then they're going to debit the discount on investment bonds for the final 2 months, for November and December. They're going to take that $49.91 times 2 other 6 months, gives you $1,664. So they're going to debit that account. They are going to reverse the interest receivable that they recorded on October 31st, because here we had a debit of 28,000. So now we're going to credit that same 28,000, and see here it says in parentheses, that's from the October 31st entry. And we're going to recognize the final 2 months of interest revenue of $15,664. So when you look at it, when you look at the interest revenue from October, we recognized 31,000, and then in December we recognized an additional 15,000. So in total, we have recognized interest revenue for the full 6 months of $46,991. But this is just how you do the entries when you have financial statements that end between interest payment dates.